Now, let's welcome on board our very first guest for today. That's Sujit Bangar, the founder of TaxBuddy.com. Sujit, thank you so much for taking our time and joining us today on The Money Show. I'm going to start off with the tax planning bit, and then we can go to the return filing bit, which is going to assume equal importance in the weeks to come. We do know that there are certain kind of investments that you have to make, like a PPF and an LIC, that will help you save tax. And then, of course, your employee as well cuts a little bit from your salary, which is then contributed towards the employee provident fund. But what are the other hacks and saving instruments that you can share with our viewers that actually is something that viewers can do or are already doing, for all you know?
Thank you, Mubina, for inviting. Very valid question, Mubina. When the financial year starts, the first and foremost thing which we should do is a planning taxes, which usually we keep it for the month of March, which is very wrong. So I will tell you, if we plan early, the benefit is we can increase our take-home income if we are self-employed, and we can increase our take-home salary if we are salaried. Now, we need not go for some odd tax saving instruments and search for something which is unique, or something which is not anybody has tried for, because most of the times we miss out on the things which we are doing already. So what I suggest taxpayers is that firstly, when the start of financial year, or at least now in the month of July, which is the second quarter of financial year, have just commenced, you check out how much tuition fees you are paying for your kids. You check out whether health checkup expenses of your parents you are planning during the current financial year. You check out whether any education loan has been availed, because interest on education loan is deductible and there is no upper limit. Like, it is not part of ATC. If you have 2 lakh, 3 lakh education loan interest, you can straight away claim it as a deduction. So you check out whether any education loan has been availed by you or your family member, so that you can claim the interest as a deduction. Also, at the same time, you please check out your home loan statement, because in home loan statement, the principal outgo is mostly missed out by users for claiming their ATC deduction. So check out home loan statement and work out what is the principal outgo and take the deduction accordingly. At the same time, if you are paying EMI for a home loan, then you can claim interest deduction up to 2 lakh, the same property you are occupying. And that is also mostly misunderstood or mostly neglected by the people. One more major aspect which needs to be considered, which taxpayers unknowingly don't look at it, is that this interest on home loan 2 lakh deduction can be claimed by both the spouses if the property is taken on joint name. Most of the times what happens, to become eligible for home loan, we take the property in joint name, husband and wife. And if the property is in joint name, then this deduction can be claimed by both. And if suppose I am having 4 lakh rupees as my interest outgo from my house property, my home loan, then 2 lakh plus 2 lakh, 2 lakh I can claim, and 2 lakh my wife can claim as a deduction under section 24. And these are the deductions which we have already done expenses, and these are the deduction emanating from them, which we should work out. And then we should see what is the remaining ATC bracket for us. And then we should see what is the cash position with us, disposable cash. And then we should plan our current investments for tax planning. And that's why this is the first exercise needs to be done. And while planning the investment for tax planning, it's better to start from today only, because if you are investing into NPS, if you are investing into ELSS, it's better to invest in a deferred manner, because in NPS also there is some equity exposure, and ELSS is a full almost equity oriented mutual fund. So if you plan from now, then you will get a deferred NAV, and that is a best way to time the market. So whatever you plan early, implement early, and start spending on tax saving instruments so that you will not feel the pinch of cash outgo in the month of March. You need not search for any fancy tax saving instrument. That's what I feel personally.
Okay. So even the simple expenses that you incur today, it could be, you paying down a home loan, or that if your family member has taken an education loan and you're paying down the interest on that. This is very important because the interest on the education loan does not even have any cap that, okay, there's only, a certain amount that you can claim to. You can claim the entire amount. So this is, a wonderful option that the government as well has given, that, look, you have incurred an expense towards an education loan. We want to be able to give you a tax break. So essentially encouraging individuals as well to not let money become a hurdle in completing or continuing their education. All right. Well, that was on the savings bit. Now, Sujit, the last 1 year has been great for those people who've been investing in equity markets. They've made a killing. They've done that in individual stocks. It's been in equity mutual funds as well. But now, unfortunately, even if it's a long-term capital gain, that means if they've held it for more than 1 year, you will have to pay tax if your gains are more than 1 lakh rupees. Sujit, any simple tips on how such individuals can cut down their tax bill?
A very valid question, because this is, I can say, in today's times, it's very important question. Most of the individuals have done trading, have invested in short term, or have done even FNO related transaction in last financial year. And as we know how the bull run was there we started, firstly market crashed, and then it was a all out bull run, and almost everybody has earned something from the stock market. Now, the major, again, I will tell you, if we are doing transaction from three sorts. First is a share trading, equity. Second is a FNO trading. And third is a equity investment, equity sale and purchase as an investment, and which we sell before within 12 months, which is short-term capital. So, in all these three sort of incomes, how the tax can be saved, and very interesting facts which we will come to know, which mostly we miss out. If we are having equity trading, then our gain from equity trading is considered as a profit or income from business. Income from business, and business it is considered as. Trading in equity is considered as income from business. Also, if we are doing future and option transaction, FNO, one major misconception earlier was that it is a speculative business, a speculative income. But after the clarification has come, now if you are transacting into futures and option, it is no more speculation. It is considered as business income. Only day trading is considered as speculation. Day trading, if you are doing, that is speculation. But if you are doing a delivery-based equity trading, it is business income, FNO business income. Now, these two sort of incomes are business income. Now, while carrying out these businesses, we do a lot of things, like we use our internet. If we are working from home, mostly last 1 year, we work from home. We didn't go to office. We are working from home, so we are paying some rent. We are using electricity. We are using data charges. So proportion of all these three can be claimed as a deduction while calculating this profit. Proportionate rent, proportionate electricity, proportionate internet charges, I can claim as a deduction. Along with that, I can claim my brokerage charges as deduction. I can claim STT paid as a deduction. And after that, I should work out my income from business, from equity trading, delivery based, or from futures and options. And then once that income is worked out, immediately I should pay the taxes so that I can save on the interest. Now, this is about the business income. If I am doing equity sale and purchase as an investment portfolio, and within 12 months I am selling, most of the times last year transaction has happened within 12 months. So then it is a short-term capital gain, and be aware there is no any such deduction which we have already explained as in case of business income. So here even this thing STT also you can claim as a deduction. Here you will have special capital gain tax rate, short-term capital gain tax rate of 15% in short-term capital gain. So that is for short-term capital gain. And if you are selling the equities which are held for more than 12 months. As we all know, up to 1 lakh rupees, there is no tax on such long-term capital gain. Here, what we can do, at least going forward, whenever we are redeeming our investment in equity, we should plan it in a deferred way. If we apply some mind, if we plan it a defer way, and we do little tax harvesting like purchasing some loss and setting off, then we can even save certain tax incidents on long-term capital gain also beyond 1 lakh. If it is up to 1 lakh, obviously it is tax exempt. So these are the points which we need to keep into mind while calculating the income from equity related transactions during the last financial year.
Okay. All right. A very comprehensive answer really on how you can manage your taxes best on long-term, short-term capital gain that you will probably be enjoying if you've invested in equities in the last 1 odd year. You know, Sujit, I know you spoke quite a bit and very thoroughly in the first answer itself on the tax benefits available for those individuals who purchased a home on loan especially. Now, you know, let's understand that how, because right now the trend that we've been seeing is that a lot of people have been buying homes as well. They may be doing it on loan, they may be just buying it outright. As opposed to now, when someone is living on rent, what are the tax benefits available to when someone, you know, borrows money and then purchases a home? If you could just compare the tax benefits available between the two.
Yeah. First and foremost, one thumb rule is that never purchase your house, your home for tax planning, because home is not a thing to purchase for tax planning. It is a byproduct, it is incidental. If we are purchasing home, then the tax saving is incidental. So I suggest everybody don't go for purchasing home for tax planning. It is a too heavy decision from tax saving perspective. So firstly, if you are of confusion whether I should purchase home for tax saving, then answer is that purchasing home is your decision based on your cash flow, based on your disposable saving which you can use for EMI, and also a personal decision within the family with your spouse and your long-term goals. Once you decide about purchasing home, then certainly there is a very good tax benefit, as we have briefly discussed in the earlier question. Firstly, principal outgo. ATC limit is 1,50,000, and from that, whatever principal outgo is from EMI, you can claim as a part of that ATC bracket. Beyond that, if the property is purchased in the name of husband and wife, both the spouse, then you can claim 2 lakh rupees interest deduction under 24 in each return. Wife also can claim it, and husband also can claim it, provided there should be that much interest paid. If interest paid is less than 4 lakh, then obviously both cannot claim 2 lakh. One can claim 2 lakh, one can claim whatever is the remaining from that. But if the interest outgo is more than 4 lakh, both can claim 2 lakh each. Apart from that, if the property value is less than 45 lakh, there is another special provision, 80 triple E something, where 1,50,000 is an extra deduction which one can claim with respect to this. If the property value is less than 45 lakh, government has brought it to promote the low cost housing. So practically, if we are deciding to purchase a home, there is these three sort of deduction, and which you can claim. Practically, theoretically, you can one can say that one can claim 1.5 lakh from ATC, 1.5 lakh from 80 double E or triple E, and 2 lakh as part of 24 interest deduction under section 24. So this is available from house property. So purchasing home is a very tax efficient decision, but it should not be taken for tax purpose. It should be taken for other things, as we said. Now, next thing, as you said about rent related thing. So paying rent is not paying rent is not a choice, because we have to take a decision. If I move to Bangalore and I have to purchase a home and it is not possible, then there is no option. I have to pay the rent. But obviously, if we are paying the rent, then certainly we can claim rent as a deduction under Income Tax Act, and this deduction is a beyond ATC. So this is more than 1.50 lakh. Beyond that deduction you can claim. There is a formula to calculate that deduction with respect to how much HRA if you are getting and all those things. So if you are staying on rent, then certainly you can claim deduction. But Mubina, major question people have as far as HRA and rent is concerned is this: if I am staying at my parents' house, then can I claim the deduction? So there is no such restriction as per Act. If you are staying at parents' house, have one proper draft, one rent agreement with your parents, and you pay monthly rent to your parents. Monthly rent should be paid to your parents, and there should be a proper documented rent agreement between you and your parent. And on that basis, you can very well claim deduction for rent paid, even if you are staying with your parents, because you and your parents both are independent individuals. Only thing ki money you have to pay actual rent to your parents. You cannot do notional thing. Real you have rent outgo should be there.
All right. Okay. Sujit, very quickly now, many taxpayers will be getting their Form 16 and Form 16As as well to file the return. The last date, of course, is not 31st July, it's the 30th of September. But what documents should they start accumulating them so that the tax filing process becomes easier very quickly?
So firstly, Form 16 is everybody will get automatically. So, and if somebody doesn't get Form 16, company doesn't give Form 16, then take your pay slips and work out competition. Secondly, please take out your 26A statement, because many times bank interest and everything we miss out unknowingly. So which you can check out on the 26A. So 26A statement should be taken by everybody. If you are self-employed business or even for salaried, you should take out 26As. And lastly, please go through all the entries in a bank statement, because some redemption, some maturity proceeds, or something which has been credited, which we forget while filing the return, and we may get a notice later on. So these are the three documents which we need to look into. And just 1 second, lastly, as I said in my tax saving related answer, please check out last year's expenses and take the deduction if not taken in Form 16 while filing the return.
Okay, very quickly then, let's take on board some questions and queries. Our first query is coming from Somil Bajpai. He says, can IT returns be filled with my signature and submitted to the IT department physically, or is it now mandatory to file your returns electronically? And also he asks, do I have to give my IT department the website username and password to the TRP, or can he file my returns if I sign and give him the IT return form as well? Can the TRP then submit the form, physically rather than electronically, because he does see a space as well for the PAN card holder to sign, and the details of the TRP can also be given in the form. So for some reason, Somil is a little skeptical of, going online and filing the return, even though it's extremely simple. Is the physical mode of filing returns still available?
Two part of his question, whether physically return can be filed, and secondly, whether the IT department website credential needs to be given to TRP. Physical return cannot be filed. You have to file electronically unless you are 80 years old. So now that option is not there. So you have to file return electronically. Secondly, IT credential you need not give if you are filing return to e-filing intermediary. There are registered e-filing intermediaries through whom you can file the return. And if you are filing through such intermediaries, then there is a OTP-based verification. These people will not ask you this IT department credentials. But if you are filing through your tax consultant on a personal level, then the tax consultant may ask you IT credentials, and you may have to give those credentials. But you can change those passwords immediately after filing the return.
Well, we'll take a very short break, but be right back with a conversation with Policy Bazaar for all you small business owners. How can you better ensure the life of your employees? A simple and a cost-effective solution for that coming up right after the break.